If you look at the typical institutional investor, you can see that they are allocated to alternatives and private markets anywhere from 20 to 30 to even 50% of their portfolios. If you look at the wealth market today, that number is 2 to 3%. Based upon our conversations with wealth platforms and advisors, we think that 2 to 3% should ultimately be 10, 15 plus percent. And if you were to do the numbers, that just means that there's literally trillions of dollars of money that's in motion.
Eric, thanks so much for joining me.
Oh, Ted, thank you very much for having me.
I'd love to have you take me through your path to getting into private wealth.
Sure, absolutely. It was a little bit of a longer journey for me. Out of college, I went to work on Wall Street. I went to work in investment banking and then private equity. And the things I really liked about both was the engagement with clients. And so I headed back to business school. And when I tried to figure out, quote, what I was going to do with my life, I decided, hey, I want to work with clients. And I ended up joining a firm called PIMCO as a relationship manager. And at first, I started out on the institutional side, covering pension plans, foundations, endowments, and insurance companies. And I got to learn about, how institutional investors think and act and, asset allocation and portfolio construction. And over time, I, migrated from that role to one role to another role, but eventually ended up leading wealth in the U.S. for PIMCO. And that's where I really got to learn about the wealth business. And it was probably my favorite job I had at the firm.
What years was that when you started focusing on wealth?
I came back from Asia in 2017 and was there for about 3 or 4 years leading wealth for PIMCO.
How did you define what that landscape looked like, whatever it was 8 years ago?
Yeah, it's interesting. When people say wealth, it means something different to different people. In my book, there are really 3 components to the wealth market. There is what I would call the ultra high net worth family office component. Those are typically professional buyers of investment solutions. They tend to have their own infrastructure, their own CIOs, and they really, in a lot of ways, make decisions like institutional investors. The second category that we think about in wealth is the wealth that's financially intermediated. So we think of those individual investors that utilize financial advisors or financial consultants or some type of platform to help with investment management. And then the third category that I would consider is a self-directed individual investor. So those investors don't use any formal financial advice. Obviously, in the asset management business, for the most part, the focus is usually on the first 2 categories. But again, over time, you might see different people focusing on different parts of that market.
What did you see about how to address, particularly the second 2? Because I think the institutional market looks a lot like the ultra high net worth market.
Sure. One of the reasons why I really loved getting into the wealth market was because at the time I moved over to lead wealth, the market was really changing. There was this real important inflection point. We talk sometimes about this idea of wealth going from 1.0 to 2.0, but the intermediaries and financial advisors all started to become much more sophisticated when it comes to portfolio construction and asset allocation. Also, at the time, we started to see this real bifurcation or transition of financial advisor business models. If you think about it, years ago, most financial advisors were really portfolio managers. They would develop portfolios for their individual clients. Usually it incorporated individual equities, individual bonds, and they were really portfolio builders. If you fast forward, we're really seeing business models change dramatically. Financial advisors now have a much broader value proposition that they're holding out to their investors. Sure, they're building portfolios, but they're also providing financial advice and planning, tax perspectives. Sometimes they're a financial concierge, sometimes a financial referee, an educator, an advisor, a therapist. And so for an advisor to be able to do all of those things, they really need to evolve the way they do the first part of that job, which is to build portfolios. And so they're starting to rely much more on model portfolios, advice, and support. So that was one really big change that we started to see 5, 10 plus years ago. The second change really relates to how asset managers engage with the financial advisors and financial intermediaries. In the US, there's over 300,000 financial advisors. It's unlikely that any asset manager is going to build a sales team that could touch every single one of those advisors. And so all of a sudden, data, analytics, and marketing became much more important in figuring out how to engage with advisors and how to support advisors. And so that was some of the reasons why I started to get pretty excited about the wealth market.
So what happened as you dove into that led you to move from PIMCO to KKR?
Sure. So, I had been at PIMCO for 17 years. I never thought I was ever going to leave, but I got a call to meet some of the folks here at KKR. And I think part of my decision-making process was this idea that within the asset management and specifically within the wealth space, the demand for alternative investment solutions was only going up. And so having an opportunity to work at a pure play asset manager that focused on alternatives was pretty exciting. And then also what was really exciting was if you looked at KKR 5 years ago, the firm really had built out world-class private equity, infrastructure, real estate, and credit investment capabilities. But the firm really hadn't built out distribution to really take those investment solutions and deliver them to a broad array of investors. And so the opportunity was to come here and really help build out distribution, which included wealth management. And so it was pretty exciting to come here. And I would say this, the people here are exceptional. Just really amazing culture, collaboration, and just some really talented folks here.
How do you think about how big this opportunity is? So this movement of private wealth assets into alternatives.
There are so many numbers that are sort of painted out in the marketplace in terms of what the opportunity set could look at. Look, here at KKR, we're really focused on just delivering investment solutions to our clients. And we don't measure success like in, AUM perspectives. But if you were to try and size the market, here's the way I think about it. If you look at the typical institutional investor, you can see that they are allocated to alternatives and private markets anywhere from 20 to 30 to even 50% of their portfolios. If you look at the wealth market today, that number is 2 to 3%. Now, maybe there are some good reasons why, on average, it's not going to reach 50%, but most individual investors can give up some liquidity. And for those investors that, again, have longer horizons, they should be able to benefit from exposure to private markets. And so, based upon our conversations with wealth platforms and advisors, we think that 2 to 3% should ultimately be 10, 15 plus %. And if you were to do the numbers, that just means that there's literally trillions of dollars of money that's in motion. And that doesn't even incorporate some of the other pockets of wealth that you might see, for example, in defined contribution and 401k space. But hard to put a number on it, but I would tell you that it's an enormous opportunity over the next 5 to 10 years.
As you look at trying to service that client base, you mentioned the intermediaries and then self-directed. Two can be very different decision-making units. How do you think about putting that together and trying to figure out what they want and need?
Today, our focus is on the intermediary part of the market. So we don't engage directly with investors. By the way, there are a lot of really great companies that have built out direct-to-investor models. For us, we want to participate in that by simply having our investment solutions available on those platforms. But in terms of us at KKR engaging directly with individual investors, it's just not our value proposition that we can deliver. So our focus really is on that intermediary part of the market. And so for us, and ultimately what I think you need to be successful in that part of the market, you really need 5 things. You need to have a brand. Make no mistake, brand's important no matter where you are, but within the wealth space, brand is really important. At the end of the day, that financial advisor is going to be sitting across the table with an individual investor, and he or she needs to understand all the different things that are in his or her portfolio, and so brand matters. The second thing is it's really important to have real quality investment solutions that are customized for wealth. And so, historically, this industry had taken some of the institutional investment strategies and just plugged them into the wealth channels. And that's okay. And for some individual investors, those drawdown or institutional vehicles might make sense. But for the large majority of individual investors and the financial advisors with whom they work, you really need a customized wealth product. The third thing that I think you need are real relationships with home office platforms. At the end of the day, you need to have relationships with some of the intermediaries that are curating what is going to be available on a platform. But then once you have that, you also need to have boots on the ground sales professionals that are engaging individually with advisors to help them understand the investment solutions and how they fit into portfolios. And then the last thing is you actually need real thought leadership and education. One of the biggest challenges that the industry will have over time is ensuring that advisors and their end investors understand how alternatives can be incorporated into portfolios, and importantly, the risks and benefits that those investment strategies offer. So at KKR, we've been investing in all 5 of those areas.
Let's walk through each one and walk through what you saw when you got here and how it's changed since. So just start with brand.
So look, one of the things that attracted me to KKR was the incredible brand that we have here at the firm. We've been operating for close to 50 years as an investment manager that's focused on multi-asset alternative investment solutions. And we have a time-tested investment process that we've been delivering out to the market. And while I would argue that perhaps we weren't as well known among wealth investors, we have the background, the experience, and sort of the high quality investment solutions that it takes to be really credible as a wealth provider. And so what we've been doing at KKR is really investing in taking that brand and making sure that the wealth market fully understands what we can deliver to them. So that was one area where I would say, it had a big green check mark at KKR in terms of the brand that we can have and offer to the marketplace.
How do you go about doing that, making sure you're not a tree falling in the forest?
When I first got here about 5 years ago, we actually didn't have a marketing department. I remember I got here and was really excited to be on the ground and meeting lots of my new colleagues. And I remember asking someone, hey, can you introduce me to someone in our marketing department? And they turned to me, they said, isn't that you? And I said, well, yes, we are, sales and product strategy, but no, we need to build out a skill set around digital marketing, channel marketing, product marketing, brand. And so the firm said, hey, if we need it, let's go build it. And so we ended up building out a fully staffed marketing effort. And through that effort, we are engaging in so many different ways to connect and reach out to advisors and ultimately, make sure that the KKR value proposition is well known in the marketplace. We've got about 25 people here at KKR that are dedicated to focusing on engaging and again, delivering that broader client experience.
What are some of the different ways you've done that sort of differently, clearly hadn't been done in the past?
So look, there are lots of different ways. So one of the ways is we've built out a real robust digital marketing effort. So again, I mentioned there are 300,000 financial advisors. The sales team can never touch every single one of them, right? But if we can take some of the content that we have and we could package it and leverage digital marketing to reach at scale a number of different individual financial advisors, that's one great way. The second thing that we've done is we've really elevated the client events and client experience that we offer. So for example, we do a KKR Academy where we bring advisors to KKR and we talk to them about our capabilities and our investment solutions. But the marketing component of that is really important, right? It's the brand, it's elevating the experience that advisors have. And then there is all kinds of other marketing techniques, paid, search, and all these other ways that we can really sort of elevate KKR. One last thing that we're super proud of is that we've created a digital education experience. It's called Alternatives Unlocked. And that's a fully multimedia digital experience that advisors could come on, get continuing education credit. And by the way, it's accessible also to individual investors as well. And we think that's a really great way for us not only to help educate the market, but also elevate the brand.
Have you thought about the kind of top of the funnel, just pure advertising?
We don't do a whole lot of pure advertising. We do a little bit of it. And the reality is that we will do things on LinkedIn and other social media, and we will try and target. But the reality is we don't do a whole lot of it today. But that might change over time.
Let's turn to this concept of customization. What's changed from the traditional structure that, say, private equity had been delivered to institutions to make more accessible for private wealth?
I think it's a combination of two things that have happened. It's a combination of innovation on the vehicle front and then also technology. Right? If you think about it, these historical drawdown vehicles, number one, they're only eligible to qualified buyers, right? And so there's a limited universe of investors that would even be eligible to invest. The second part is it's a very challenging administrative burden to actually allocate capital to a drawdown vehicle. The subscription documentation process is pretty extensive, and there's a lot of hoops that individual investors would need to go through. Now, if you're a large sovereign wealth fund or public pension plan that is used to doing these things and obviously an eligible investor, no problem. But if all of a sudden you're a financial advisor and you work with 300 clients and maybe only a couple of them are eligible and they've got lots of accounts and it's complicated, all of a sudden that's a pretty huge barrier to allocate to an alternative investment solution. Over the last several years, however, innovation in vehicles has really made a huge difference. So through whether it's an interval fund, a tender offer fund, a non-traded BDC, an operating company, there are now a number of new vehicles that asset managers can utilize, which really widen the aperture for investors to invest. And that includes not just qualified buyers, but also accredited investors. And then for some vehicles, all the way down to the non-accredited investor. The other thing is technology has also played a part of this. Even these evergreen investment solutions, some of them do require subscription docs, but through simplified docs as well as a technology solution, onboarding these into an advisor's client base is a whole lot easier. So I would say both of those things have created or lowered the barriers for advisors to allocate client portfolios to alternatives.
If you look across the different strategies that you offer, private equity, credit, infrastructure, what's changed that goes into these vehicles compared to what you delivered in the past?
That's a really important question. Every asset manager has approached their wealth effort differently. So I can speak to what we do at KKR. So all of our evergreen investment solutions have the same investments that you would find in our drawdown vehicles. And that's a really important differentiator. When we decided 5+ years ago to really build a wealth effort, we had two options. Option one was to go and create investment solutions that invest in things other than what we have already been doing, or go through the really complicated challenge of structuring these vehicles, both the drawdown vehicles and the wealth vehicles, so that they can invest pari passu. And we said, look, we've had this time-tested investment process for 5 decades. We would love to be able to offer the investment capabilities that we built and honed to our wealth investors. And so we went ahead on all of the investment solutions we offer. They all essentially share deals and share transactions with the institutional vehicles.
I'd love you to walk me through an example of either how that's done or where you solved something that was complex to make it work.
If you were to look in many alternative firms, especially in private equity and infrastructure, they typically follow a waterfall approach where you may have a flagship strategy that is first in the waterfall. And then second in the waterfall, maybe there are other strategies that could participate in a deal. And then maybe third in the waterfall, you could offer co-investment. So most alternative firms, their first in the waterfall is always just their institutional vehicle. We have created in our documentation that first in the waterfall to have an allocation to our wealth vehicles as well. And that takes a lot of forethought because if you think about it, when you launch your drawdown vehicles in the documentation, it will stipulate that waterfall and that priority. And so years and years ago, we said, hey, we want to make sure that we can carve out some allocation for our wealth investment solutions. And so that's one example of what we've done to make sure that we can share that priority.
How do you think about the potential for dilution of the quality of return when, if in fact all of this money does come in, you have that much more money you have to put to work across these different pools?
Look, I mean, I'll tell you this. First and foremost, we're focused on delivering investment performance to our clients. And I would say this, the minute you start to dilute that is the minute that you no longer are consistent with your brand. You're no longer consistent with your value proposition. So what I would tell you is this. I think first and foremost, asset managers always need to make sure they're delivering what they promise they're delivering. In terms of the potential risk as assets move in, more and more assets move into these markets. Look, the reality is private markets are growing by leaps and bounds. And if you think about it, even in the equity space, I mean, more and more companies are staying private for much, much longer. And so I would tell you that it's early days before we worry or get concerned about, our ability not to be able to deliver returns. And I think that's pretty consistent with what, our clients are seeing. But I think we've got a lot of time before all of a sudden there's going to be some type of challenge for us to deliver.
Let's turn to that next leg, which is relationships and boots on the ground. What have you had to do to be able to reach as much of this market as you can?
When it comes to boots on the ground, look, we've had to hire a number of people. When I started here at KKR, we had 5 people that were focused on wealth globally. And most of those individuals, all of those individuals were really just focused on engaging with the home office platforms. Today, we have a whole sales team in the US that is out in the field that are wholesalers. We've got external wholesalers, internal wholesalers. We have folks that focus on the wire channel, the IBD channel, the RA channel. We have folks sitting in London, in Zurich, in Hong Kong, Singapore, Tokyo, Australia. And so we've really had to build out an on-the-ground sales team. And their goal, each of them wake up every day engaging with advisors and meeting with them oftentimes one-on-one in small groups. And so it's a really important effort. At the end of the day, advisors want to hear from their asset manager and their whole, their relationship manager coverage.
How many people are on that team now?
If you look across KKR, roughly a third of all of the folks that are in distribution are focused on our wealth business. And that includes, if you think about it, a home office coverage team. That includes a wire sales team, an independent broker-dealer sales team, an RIA sales team. And it also includes individuals that are in Europe and in Asia on the ground covering clients. So it's gone from being a very small part of our overall distribution effort to being, frankly, one of the biggest groups that we've got within overall sales.
As that team is having conversations with all these advisors, what are you hearing about what solutions they're looking for?
In 3 broad categories, we hear some advisors that say, hey, I'm really trying to deliver, a more resilient income stream. Some advisors say, my clients really want to diversify and dampen volatility. And then we've got other clients that say, look, we're really trying to enhance returns overall, total returns. Once we understand what that advisor is looking for, we can customize the investment solutions. If someone's really focused on enhancing yield, enhancing income, we'll talk a lot more about credit and real estate. If they're really focused on sort of maximizing returns, we'll talk a lot more about our private equity solution. And so, we're really trying to figure out what outcome they're trying to generate and then deliver investment solutions back. Now, I would say this, another real important theme we hear all the time is, how do alternatives work? For many advisors, alternatives are really new to them. And so explaining to them how the vehicles work, how the liquidity works, where they fit in a portfolio construction is really important, because we not only want to make sure the advisors understand, but we want to make sure the advisors are equipped to then turn around and have conversations with their clients on it.
That leads into this whole concept of education. Right? You mentioned the academy. There's a couple examples there. What level of sophistication do you find the advisors have when you're trying to make sure you're educating them properly about this fit in their portfolios?
Yeah, Ted, that is one of the things that I love about wealth, is that there is such a wide range of advisors. We work with some advisors that I think are more sophisticated than some of the big sovereign wealth funds and pension plans we work with. On the flip side, we work with some advisors that have never allocated to anything other than public equity and public fixed income. And so the knowledge difference is wide. But that's great because what we've done is we've developed content that supports each of those different levels. So we'll have content and education that talks about what is private equity? How does it work? Why would you invest in private equity? We also have content that goes much deeper, that talks about the J curve. It talks about what the difference between gaining exposure to private equity in a drawdown vehicle versus an evergreen vehicle. And then we have a whole series about, okay, well, how do we add value in private equity? And we take clients through our value creation toolkit. And so we really try and meet advisors where they're at. But what I would say is this: advisors are building knowledge. We're seeing it every single day. And I would tell you that's one of the reasons why the allocations to alternatives are going up, because more and more advisors are getting more comfortable with the asset class, with private markets, and understanding the role and the potential benefit within portfolios.
I'd love to dive into evergreen structures generally. It seems like whether it's from ease of subscription or liquidity, that is the vehicle that a lot of the wealth channel is exploding into. How should an investor think about the differences between the two?
There are obviously meaningful differences, but if we go back to sort of the client needs, the evergreen vehicles solve a number of different problems. So the first is that you don't have to wait for the next fund launch before you can gain exposure to the market. And for advisors, by the way, that are constantly growing their own businesses, imagine they're trying to build portfolios for their clients and they have to wait until the next drawdown vintage for them to be able to allocate. So that's one big difference. The second really important difference is the accessibility. All of those drawdown vehicles are really for qualified buyers only. Whereas, for example, our private equity solution is for also accredited investors. So now imagine that you're a financial advisor. You want to learn about private equity. You want to understand the benefits of it. You spend a lot of time learning about this, and you're ready to start incorporating it into client portfolios. Can you imagine if you spend all this time, and of your 300 clients, only 8% of them actually are eligible to invest in a drawdown vehicle, where maybe 25 or 30 or 40 or 50% are eligible to invest in the accredited investor product. So that's another really important difference. There's tax reporting is going to maybe be complicated regardless, but our Evergreen investment solution has more of a simplified K1, so it's a little bit easier, but it's still a little bit challenging. But I think another important difference is that it does provide some liquidity. And so, again, there's a limit to liquidity in different market environments, but at the end of the day, individual investors have the ability to get some liquidity, again, some. But I think the best difference, which works very well for individual investors, is that they don't need to manage cash flows. So if you look at the most sophisticated institutional investors, they may target a 20% exposure to private equity. They may utilize lots of different drawdown vehicles, and they're constantly matching distributions and new capital commitments. Individual investors and advisors, that is a very big challenge. And so being able to stay fully invested and get invested day one is a huge benefit. And frankly, one that just fits so much better in the wealth market. If you ask me, I think the drawdown vehicles serve a very important purpose for institutional investors, but over time, I would expect 80+% of all wealth flows to go into these evergreen investment solutions.
So you get all these benefits, right? Get liquidity, you get ease of access, ease of tax treatment. What are the trade-offs?
Investors need to understand that these vehicles typically have quarterly liquidity up to a certain maximum threshold. And I think that's pretty important. Now, by the way, there's never a get without a give. And so if you want to benefit from the illiquidity premium, you have to be willing to give up some liquidity. And look, there is some complexity from a tax reporting perspective. And there is some time that advisors need to take to understand the investment solutions, right? Most advisors that are new to this, they have to understand what's in the portfolio, the risks, how the vehicles are structured, and they have to spend the time and explain it to investors. But I think, once you understand the liquidity and you understand the risk profile of the investment and how it could play into a portfolio, I think there are a lot of really strong benefits.
How do you think about the costs of access. And I guess that's from two perspectives. So yours is a business delivering two different solutions with two different fee streams, and then the advisors and the investors and the costs that they incur in investing in a strategy like this.
Maybe to start with the second question, look, clearly the alternative market and private markets has a different fee profile than public markets. I'd also tell you that the value add is much more significant. Whether it's in credit or infrastructure, real estate, there's anywhere from, a couple hundred to hundreds of basis points of excess returns that you can generate relative to public benchmarks. And so I would say, and we always encourage advisors to think about performance and think about returns net of fees. And that's where, by the way, it's really important to think about the manager that you're utilizing, because what we have seen in private markets is a very, very wide range between first quartile and fourth quartile managers. And so there, I would say, if you're a fourth quartile manager, you're probably not delivering value above your fees. If you're consistently a first or second quartile manager, then your net of fee performance really makes sense. In terms of us as a business, look, I would say two things. We believe in having a diversified business. We encourage our investors to think about diversifying portfolios. We do the same, and we diversify by the asset classes that we manage. We diversify by the pools of capital that we manage for. And so I would tell you that we're thrilled to be able to have a very well-balanced business across our institutional, insurance, family capital, and wealth efforts.
In the drawdown structure, everything's historically been measured by IRR.
Yep.
Evergreens, it sounds like it's more of a time-weighted compounding type return. How do you think about making sure people understand the differences between the two?
You're right. All else equal, you would see the IRR of one of our private equity drawdown vehicles, for example, higher than the expected IRR that you'd find in an evergreen private equity solution. Having said that, because you're investing fully invested day one, your multiple of money is going to be higher. There are good reasons why an investor who is eligible to have both might include both. But our goal is to make sure investors understand what the return expectations should be, and whatever metric they want to measure it against, they understand what the expectations should look like.
When you do so much yourselves and to build this up, really curious about external partnerships, most notably with Capital Group.
It's interesting. We are super excited about the Capital Group partnership, and for a couple of reasons. But if you were to look at where we have focused the majority of our time within the wealth space, it's with those accredited investors and above. And we've built out a sales team, and we're super proud of it, but it's not the size of potentially some of the other traditional asset manager sales teams that are out there. And Capital Group actually approached us, and they had their own business strategy around deciding to want to partner with an alternative manager. And it was just such a perfect fit. They have this really great, strong business, especially in the independent broker-dealer channel, but frankly, with wires and RIAs. And they, in partnership with them, were building these investment solutions that are available for the non-accredited investor. And so that, to us, was completely orthogonal to what we were doing. And so that partnership enables us to deliver private markets to even a larger number of investors. I always talk about, in one of the first meetings we had with Capital Group, I was probably like one of the most excited people in the room. And I talked about my mom. So my mom is a retired New York City school teacher. She taught in the city for 36 years. Sorry, Mom, if I got that wrong. And she is not an accredited investor. By the way, she would love to invest in KKR investment products, but the reality is for her, a dedicated KKR Evergreen investment solution just doesn't make sense. But let me tell you, the investment solutions that we're creating in partnership with the Capital Group would be perfect for her. And so that is one of the reasons why we're super excited about partnering with the Capital Group. They're a world-class, investment management firm as well, and just a great, a lot of cultural overlaps too.
So there are other ways your mother could access what you're doing, most notably KKR stock. So how do you think about that as a potential solution for this channel?
Anyone could buy our stock, which is certainly one way to get exposure to some of these investments. But if you think about it, the investment in KKR stock trades at a multiple to earnings and reflects the number of things that we do here at KKR, which includes asset management. It also includes the insurance company that we own, Global Atlantic. And so it would not be as a pure play exposure to, say, private equity or infrastructure or real estate or credit. And obviously, as an investor, you're customizing your portfolio based upon your goals and objectives. So for my mom, she'd probably be allocating more to, say, private credit or real estate than likely, a larger exposure to PE.
As you look at this space, kind of from a sense of competitive landscape, how do you think about who the winners and losers are likely to be on the manager side?
There are, these 5 things you need to do really well: brand, customized products, platform relationships, sales team, and then marketing and analytics and data. So it's interesting. When I got here to KKR, we had a really great brand and we had this really great investment capabilities. We did not have a huge investment in platform relationships or sales or marketing. But my view is that the harder things are brand and investment capabilities and products. My gut tells me that over time, it's the alternative managers that have brand and have real investment capabilities that are willing to and invest in the other 3 areas that are likely going to win. The other thing is this: larger alternative firms that have multiple investment solutions have a greater ability to build out the capabilities on the sales, on the distribution front to win. For example, we have a sales team that goes out to the market, and we've built out a team that is going out and spending time with a financial advisor. The advisors are called all the time by asset managers, by wholesalers, and they're going to pick and choose which investment managers they're going to spend time with. If you're an asset manager like KKR that has capabilities across PE, infra, real estate, credit, we also have capabilities across macro thought leadership and asset allocation and portfolio construction. The value that we can deliver to an advisor is a whole lot more than a value that maybe a single asset manager that has one specific capability can deliver. And so my gut tells me that there actually won't be a lot of winners. There'll be a handful of winners in each of the asset classes, and they'll likely be the larger, well-branded alternative firms.
How do you think about risk in the space? And the one that people raise a lot is, how do you bring liquidity when underlying assets are less liquid?
Yeah, the reality is this: there's no magical wand that you can wave over a private market investment and make it liquid. So that's the reason why, in my mind, the wealth solutions that take advantage of these limited liquidity vehicles are the way to get exposure: the interval fund, the tender offer fund, the operating company. There are parts of the market that are contemplating trying to wrap private markets in daily liquid, whether it's a mutual fund or an ETF. And again, if you're going to do that, then you need to have some liquidity function, and that always is going to come at a cost. It could be an explicit cost, it could be an implicit cost, but at the end of the day, you can't magically say something that's illiquid is liquid, and if it does become liquid, then the illiquidity premium likely is going to go down or go away.
That leads to this question of what are the implications of all of this innovation to bring alternative strategies to the private wealth channel and all the money that could come in? What does it mean for future returns, for institutions that are already in the space watching this happen?
A couple of things. More capital available will create more opportunities for companies to participate and raise capital in the private markets. And like we saw during, the recent COVID crisis, we saw a tremendous number of borrowers shift from the public market, debt market, to the private market. And so what I would tell you is it's just going to give companies a lot more flexibility and opportunity to finance themselves in the ways that make sense for them, their business model, and what they're trying to achieve. Like, in my mind, these markets are huge and there's a lot of opportunity. And so I don't worry about diminishing, future returns. What I would also say is this: it will require the asset manager to make sure they stick to their discipline and their time-tested process. And I will say this: sometimes you'll get asset managers, as they grow their businesses, they ease their underwriting standards or they ease their expected return profiles. And so I would tell you that, by the way, could happen to anybody. So the importance of it is to have a manager that you trust, that you know is going to deliver on their value proposition. And if it's in private equity, it's value creation. If it's in credit, it's maintaining a very high level of underwriting standards. But I think we have a long way to go before we're all of a sudden sitting here to say, hey, we can't deliver on our expected returns that that we're engaging with our investors.
From the seat you're sitting in with all of this activity happening and you see it accelerating in fund flows, what could go wrong?
Look, I think the biggest thing that could go wrong is that these products are not sold appropriately. And I think we saw a little bit of that in the past. But I think the biggest risk here is that advisors don't spend the time to fully understand the liquidity profile, the risk profile of these investments. And so that in some type of more challenging market environment, investors expect liquidity when they shouldn't. Now, having said that, I do think that we as an industry have come a long way in educating investors on how these vehicles work. But nonetheless, I think it's really important for us to all make sure we're constantly reminding the intermediaries, advisors, and the advisors are engaging proactively with their individual investors to fully understand the liquidity profile of these vehicles.
As a public company, you often make projections. And I'm curious publicly what you've said about the growth that you see coming for KKR in this channel.
I think our co-CEO, Scott Nuttall, was on the record saying that over time, we would envision that 30 to 50% of our capital that we're raising is coming from the wealth channels. It's an exciting part of the market, and it's one where the demand for what we deliver is only going up. And so, I just see a lot of opportunity for us to help our clients.
All right, Eric, a couple last questions here. What's your favorite hobby or activity outside of work and family?
So I grew up playing chess. I love playing. I wish I were better, but it is an amazing game. And then another sort of hobby I have is I love to run. It's great for the mind. It's great for the body. I do it with my kids. And although it's getting a little bit harder for me to keep up with them, but both of those things I love to do.
What was your first paid job and what did you learn from it?
Growing up as a kid, I was really into computer science, and I started a little tiny company basically setting up individual personal computers for individuals and teaching them how to use it. That was my first real client experience. And it was actually really fun. I learned a lot about sort of how to, engage with clients.
What did you learn from?
I learned that you really need to meet your client where they're at. There were some clients I worked with. I'll never forget one of them, Irving Best. And he was probably in his late 60s, and he really wanted to learn how to use the personal computer. And his knowledge base was pretty much zero. And so patience, understanding, and that was a really good lesson for me.
How's your life turned out differently from how you expected it to?
I grew up on Long Island. I never left the Eastern Seaboard until I was, I think a junior in college. And if you had told me, hey, Eric, you're going to travel around the world, you're going to live, in Asia for a number of years, I would say no way. But that is definitely one thing I would not have expected, but I'm grateful for. I mean, my life has totally changed given the experiences that I and my family have had outside the U.S.
What's a mystery that you wonder about?
My mom never allowed pets in the house growing up. But during COVID, the Mogelof family broke down and we got a COVID puppy. And he has become like one of the most important members of the Mogelof family. And I will tell you, I would love to know what that guy is thinking about, how he's feeling, and importantly, how in the world does he know to come and hang out with me at just the moment that I need him?
All right, Eric, last one. If the next 5 years are a chapter in your life, what's that chapter about?
So I'll give you personal and professional. On the personal side, I've got 3 kids, and the next 5 years is about really launching them. I've got a freshman in college who will be entering the workforce. I've got a junior in high school that's going to head off to college. And even my 7th grader will be in that 5-year window out of the house. And so my wife and I are really focused on advising them in sort of their next chapters of their own lives. Professionally, I'll tell you, I'm really focused on developing talent. I am so fortunate to be here at a company where we have so many amazing professionals. And so I view my goal, one of my most important goals over the next 5 years, is to really help them grow in their roles and achieve the greatest impact to support our clients and support the firm. And by the way, the last thing I'd tell you is I hope this is a chapter where our alternatives business becomes even more accessible and my mom can invest.
Eric, thanks so much for taking the time.
Ted, thank you very much for the opportunity.